I can only imagine the conversation or the look the wife gives the husband when he's like, "Hey, honey, we're like 100K short on the rental project because the HELOC only goes up to 80%."
I
Oh
mean, that's
man.
that's the hard part. Like, and it's a primary home. It's not like a investment property, right? Where you
Yeah,
can get
yeah.
like a
A home equity line of credit or a HELOC is like a Swiss Army knife of borrowing for everyday Americans with a mortgage. But there is a ton of misinformation floating around. Some people think you could just get one as long as you're in a mortgage. Others think that it's like a giant credit card for vacations. And still others think they're just like all the same. All HELOCs are all the same. Spoiler alert, none of that's true. Welcome to the channel. We're the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. Today, Jason and I are going to break down the 5 most common myths about HELOCs so you don't get blindsided. But before we move on, thank you to everyone who's subscribed to the channel. It really does help us out, not only psychologically, but helps us to spread the word to people who really need it. We hear all the time from clients that, there's no one talking about this kind of stuff online like we do, or that they wish that this kind of stuff was taught at school, but it wasn't. So here we are.
absolutely not.
Yeah.
Because if you think every HELOC works the same way, that's literally the fastest way to get blindsided.
Yeah, it's kind of like there's a really funny video that I watched about someone trying to sell their BMW. It was like an M something, right? But they thought it was an M5 or an M3, but it was actually like an M350 or M340.
Mm,
It has M in
not
front
an
of
M.
it. It's not an M.
Mhm.
It's not the same car at all, right? They're like, I want $100,000 for it. They're like, this is worth 60. So yeah, HELOCs are kind of the same way. They all
Yeah.
might say the word HELOC in front of it, but depending on the lender, there's different guidelines, there's different restrictions, there's different benefits.
Everybody thinks when they think HELOC, it automatically means it's the 10-year interest only program that all the old school banks they've always offered, right? And the truth is every lender structures them differently. So some are variable, some are fixed. Some give you 10-year draw periods, some give you 5, some give you 3, right? And that's that's the myth, right? It's that 10-year interest only HELOC. And the crazy part is no one talks about the payment shock, right? From the banks of when that thing triggers if you owe money on it. That'll typically turn into a 20-year amortization. And yeah, so those longer draws like the 10-year, it sounds really attractive because you get more time and it sounds really great because it sounds like that interest only payment's lower. But in reality, you're trading that for a much higher rate and exposure to interest only debt for longer if you have no prepayment plan. So in my opinion, it's not the best product out there. It's
Yeah,
I,
I,
I
I literally, I literally think we are the only guys on YouTube talking about the difference between a variable and a fixed rate HELOC.
not
I
even just variable and fixed rate, that 10-year interest only. Like if you look at the numbers, you're paying a higher rate for the 10-year interest only product because it's a riskier program. Like imagine
yeah,
trying to get a
no one talks about that.
conventional 30-year fixed rate mortgage. Sorry, let's rephrase it. Let's look at getting a 30-year interest only first mortgage with a variable rate. That's like the most riskiest features all added into one, and they're giving it to you and marketing it to you as a superior product for line of credit access. It's when you strip that back and you look at it with clear eyes, right? Take that, like, what is it? Like, it's not all rainbows and butterflies, and it's like those rose-colored lenses, right?
Yeah, yeah.
Interest only is a very high risky product, right? Variable rate, another risky feature. So it's like you combine that with a line of credit. It's hard to qualify for that with the banks, by the way. So again, everybody's just so used to that because that's what the norm became, right? And once people start learning about like fixed rate HELOCs, um, they actually prefer it once they actually sit down and understand it. Because yes, it's a shorter redraw with 5 years, but it's at a fixed rate. That means you get stability. You know exactly what your payments are because they're fully amortizing on what you're using. And you're not gambling on an interest rate that could balloon years down the road, right? So yeah,
Yeah.
it's nuts, Peter.
Yeah, I mean, before we move on, full disclosure, this channel exists to bring free information to everyone out there about mortgages. We're actually, our most successful videos are about HELOCs. I guess people are very interested in it, but we are brokers. We are mortgage originators. We do these loans. So if you guys do see these ads floating around, it may or may not be the same product, but definitely the link in our description is the one that we're talking about. So use that link, schedule a call with us, and we'll talk to you guys over the phone, over email, text, whatever you guys prefer.
Exactly. And just to recap on that first myth, though, before we jump off, I have so many clients saying, I want that 10-year draw. I want that interest only payment. It just sounds safer. But again, when you really peel back the layers of that onion, it's like the worst thing out there. This is our like a banner announcement to everybody. Not all HELOCs are created equal. And a longer draw is not automatically better. It usually comes with higher rates because it's more risk to the bank to give you access to your home equity for that long period of time, which is why they're saying if I'm going to give you a 10-year HELOC, it's going to be variable rate because I want to make sure I'm still profitable regardless of market climate. If prime rate drops, you'll benefit. But again, to protect my investment into you having access to your home equity, if the market gets worse and prime rates continue to go up, I'm going to stay positive or make even more money because I have the ability to adjust your rate up. So that's the reality of it. It's not just today because I have a couple clients right now that really want variable rate HELOCs because they think in the near term rates are going to drop. Yes, but you're already starting at a higher basis. So it's going to take a 2% rate cut to get to a fixed rate HELOC today with a 5-year draw. It's a very small group of people that will benefit from that, but you're paying for it because those banks are giving it to you for quote unquote free, but they're making so much more because they're charging you 2% more than what it should be at any given time. And they're protecting themselves at the back end. Because if the rates get worse, you're paying for it and they're still saving their profit margins.
Okay, let's get into myth number 2. And you had a great line in a previous video.
Because that's the most important piece in this puzzle. Because like a high income doesn't erase bad ratios, right? Capacity is as important as collateral.
All right. So basically what
It
that means
happens in the
is,
moment. You just never know.
yeah, I know that was a really good one. Basically what that means is it's not just about how much equity you have in the house. It's about your total credit profile.
Exactly. Because it's just because you have equity, like equity alone doesn't qualify you. It's one of the starting points of being eligible to get a HELOC. So you're not going to get a blank check from the bank. We want to know that you're going to be able to repay whatever you're going to be borrowing, right? So they're going to look at your credit score, like your income stability, your debt to income ratio. Equity is just that one piece of the puzzle and one of the levers that we have to push and pull with to get you qualified for that. We've seen people with $1 million homes, or multi-million-dollar homes, get turned down for a $50,000 HELOC, and the reason behind it, it's their debt to income was too high. They didn't have the income to support that with their current debts or current mortgages with the new HELOC, right? So it wasn't an equity issue; it was their ability to repay issue.
If you have any questions about HELOCs or HELOANs, reverse mortgages, or mortgages in general, use the comment section. Let us know what your questions are. And hey, maybe it'll become a video topic one day. But we'll definitely get back to you in the comment section. All right, let's move on to myth number 3. So if I have $200,000 worth of equity in my $400,000 house, I should be able to draw $200,000 from my HELOC.
Yeah, that's the most common misconception. Like I hear this one almost daily from at least half the people that I speak with. So it's like just because you only owe 200 grand and your home is worth 400,000, the bank's not going to give you access to 100% of your equity, right? There's going to be caps, and those caps can be either state specific or lender specific, and it could put you somewhere between uh, no more than 80 to 90% of the value of your home, right? Minus your existing mortgage. So that's the lender's safety cushion. It protects them in case of home value dips or market shifts, right? So again, a different example is say you have that $750,000 home and you owe about half a million on a mortgage and you have that $250,000 in equity on paper. Like, yes, you have 250,000 in equity if that's what the market price is, but the only way you'll realize that is if you sell the home. But if you want to get a HELOC, knowing the lender will lend maybe up 80 to 90%, that means you might only have access to about 100 to 150,000 of that equity, not the full 250,000 that your home is worth. But yeah, this one catches a lot of people off guard because they think they can access the full equity of the home today, and they do a big renovation project, right? And they think, okay, like I'll add a new pool, I'll redo the kitchens, floorings, and bathrooms, right? I don't know. It's like something massive, right?
Oh my
And they
god.
budget like
Uh,
200 grand on it, thinking I can get 200 grand out of my equity because I have
right.
250,000, right? That's like
Yeah,
almost
yeah.
95%. It's like you're not going to get that. You're going to end up like
That's nuts.
dipping into savings if you have it, or they'll try to get a HELOC and they're like, oh, shoot, I can only get them at like 100, 125,000 because the income doesn't support it, right?
Oh,
And now
that's
it's like,
yeah.
what do you do?
I can only imagine the conversation or the look the wife gives the husband when he's like, "Hey, honey, we're like 100K short on the rental project because the HELOC only goes up to 80%."
You're what?
I mean,
Oh, man.
that's the hard part. Like, and it's a primary home. It's not like a investment property, right? Where you
Yeah,
can get
yeah.
like a hard money fix and flip loan on it. It's like, and no one, and even in those cases, they're not going to let you borrow more than like 70% loan to cost, right? So it's like
Yeah. Oh,
it's
man.
it's nuts because it's like
People make plans without planning.
viewers, if you have any like plans on using your equity, click the link in the description, right? Like set an
Yeah,
appointment with
yeah.
us. Like take a look at what your scenario could be and would be, right? So that you're not in the middle. You don't be this customer where you're mid construction
We'll
and you
figure it
can
out
only finance
later.
half of it, you know? I mean, or I don't want you to be that customer because I hear this customer, I run into this customer a lot too. So it's like it's it's a really sucky place to be in. Uh, it's just
Oh, man.
yeah.
Okay,
Equity on
we shouldn't
paper is
laugh.
not
It's
cash
like
in hand,
people are stressed out
family.
about that.
Equity on paper is not cash in hand, right?
Yeah.
So remember that. Lenders
Alright,
limit
we don't
how much you can actually access. And if you don't plan for that, you could run out of funds mid project and you're gonna be in a difficult spot to say it nicely.
I shouldn't laugh about that. That's really bad. It's a bad situation to be in. Don't do that, you guys. Click on the link below. Know your number before you commit to a contractor and to a project. All right. So let's move on to myth number 4.
Mm,
I even saw a commercial where they put a HELOC on a credit card
mhm,
just to reinforce
mhm.
that mindset. That's
With
insane.
cash back, right? It's
Yeah,
like,
dude, that's so crazy.
dude, that's just so nasty the more I look at it. Like, I
That's
know what
so
company you're
bad.
talking about, but the gimmick is so good because it just
Yeah.
makes people wanna spend, you know? It's a HELOC is not
Yeah.
for tickets to Disneyland. It's not a ticket to, like, take a
The Blackpink
cruise or a
concert.
vacation or, like it's like if I'm watching Caleb's financial audit, right? And I imagine some of
Oh,
those
the guy that
scenarios, like
yells at everyone?
yeah, like that guy, like I see him, I'm like, "Oh, man, like if I wanna put that guy in front of people that use a HELOC like that, because it's like it's gonna get you in so much trouble because it's like yes, it is flexible access to your home equity in the form of cash, right? It's secure to your home though, so that if you misuse it, you're putting your house at risk. So it's like, why would you gotta treat it better than a credit card? Because if you treat it like a credit card, it's the fastest way to turn your short-term spending into long-term regret. And I see a lot of people regret all of their credit card spending because that's why a lot of people are asking for right now, the HELOCs. Just because we get you the HELOC doesn't mean you can use it like the credit cards. Like that's only gonna hurt you. Like you gotta use it. You gotta have a good purpose for it, right? Be smart, like do a renovation that adds value. Consolidate your debt because you're spending 20 something percent on interest compounding daily. Or it's for education and it's gonna end up helping you make more income later or your kids' education, right? Give them a head start in life.
Hmm.
Or like you have investments, like you're gonna fix that rental property you had that you've owned now for 20 years. And instead of collecting below market rents on it, you're gonna collect at or above market rents with a long-term tenant instead of watching that property turn over every year because no one wants to stay in it, right?
Let's move on to myth number 5. The myth that a HELOC has no tax benefits whatsoever, which is not true. There are certain, remember, we're not CPAs, consult your CPA on this. There are certain use cases of a HELOC where you can get some sort of tax benefit or some sort of tax exemption.
Yeah, it's definitely this is definitely a myth, especially if you don't document it properly. There is no tax benefit for using a HELOC, but there are benefits if you use it properly. What I mean by that is like how you're using it, right? So like what could be deductible would be like a major repair to your home or renovation. And it's not just something cosmetic, right? It's not like painting your walls or redoing the flooring because it's like looks nice, right? It's like major bone upgrades. Like I had to replace the HVAC and furnace, or I had to replace the full roof, or I did a major renovation and added a extra room, like another 500 square feet to the property, right? Those things are going to count as improvements to the home, which increases your cost basis. And that becomes a, to a point where you can start making interest deductions on that portion of what was used on the HELOC because you're reinvesting that equity to your property, your home to enhance it. What won't be tax deductible, again, consult with your CPA, but consolidating your personal debts, right? That's not going to count. Vacations, cars, lifestyle spending. Um, yeah, it's like none of that will count at all towards it. So it's 50-50. Like if you're truly using it to improve your home, you're gonna see potential tax benefits from it. And again, like I've had clients take 75,000 from their HELOC to pay off credit cards, and they assumed they deduct that interest over time with their CPA, but unfortunately, that's not eligible to be a tax deduction. So there can be tax perks with the HELOC, but it's only when it's tied to home improvement. And just don't assume that every use qualifies as a tax deduction.
Yeah, that goes back to like making a plan without making a plan. Like, like you have
Yeah.
to, yeah, if you have ideas of what you want to do with it, please, you know, spitball with us first. Use us as a sounding board. We'll tell you whether you need to get a more professional insight, like a CPA, to consult with. But if you're just like making up plans and be like, yeah, I'll figure it out later, there's not much we could do to help you.
Yeah, I mean, let's talk before you make those decisions, right?
Right.
Because your options, as from a lender's perspective, mid construction are out the window once you are tear down that wall or the bathroom is removed from the house. Because typically, with a mortgage or loan, your home shouldn't be in the middle of construction. You won't be eligible for it. So do
Oh,
it
man.
before you
Yeah.
tear down something or take a wall out. Like, because in order to get that loan, you're gonna put a wall back in to tear it out again, right? So it's literally like I've heard of situations like that. Like I had a client say, I'm going to start this beautiful renovation project. And I asked, did you start on it? Because we can't be in the middle of construction. And he said, no. And then right before the appraiser gets there, he starts tearing the siding off the house. And I'm like,
Oh my
good
god.
God, you have to actually put all of that siding back up so he can say it's a whole home. And then you can start the renovation. They got too early. They got too eager. They started the
Wow.
construction before the appraiser got there. And before the loan
That's
was
so
done.
that's the equivalent of someone, getting into escrow and then buying a car, right?
Oh, that's so common too. It's not the car. They end up going out and buying like new washer and dryer, refrigerator, and
on
financing it
on finance,
at
yeah.
0% interest. I'm like, dude,
Right.
like, come on, like worked so hard to get that house, and then like now you can't get the house because your debt to income just went through the roof because of that washer
Yeah.
and dryer and like $30,000 worth of furniture you bought and
Uh,
financed
was
the week before
was it worth it?
moving.
Was it worth
Was it
it?
worth it? Now you have new furniture and appliances you can't even use in your apartment. So
Oh
it's
my
like,
gosh.
what are you gonna do with it?
You have to pay for public storage, and then that's even more money.
Oh, no.
Oh,
No, yeah,
man.
like,
Okay,
luckily,
so,
we were able to fix those, but most
yeah.
people, yeah. Go ahead.
The moral of the story, you guys, is there's a lot of misinformation out there, and then there's a lot of information that people just don't know. This video, if you found it, like, congratulations, you just got a snapshot of mistakes that people have made, and information that you probably have never even heard before. But there's a ton of information that you probably haven't heard yet either. So do yourself a favor if you are considering a HELOC or a HELOAN or any type of equity loan, or even trying to buy a home, use a link in the description, schedule a call with the Clear Close. We will help navigate this path with you. So, yeah, use us as sounding boards, use us as your professionals. Like Jason always says, we are going to be your partners in your real estate investment or your real estate purchasing journey. So, once again, we are the Clear Close, the mortgage experts that help you get clear to close on your next mortgage. And stay tuned and subscribe for more, because we're going to have more of these myths coming out in future videos. All right, that's it from us. We'll see you guys on the next one. Hey, if you want to know how a HELOC actually works, like deep dive, we made a video for you. It's right here. You can click that top video. Or if you want to know what's better for you, a HELOC or a HELOAN, we made that video for you too. Click this video right here.